Well, let's get across the market open now. Zach Riaz joining us from Banyan Tree Investment Management. Zach, welcome back to you. Of course, all eyes on the Middle East. Further developments there. That's proved to be a drag on equities. Oil prices surging off the back of that news. Do you need to be cautious in the market at the moment?
Good morning, Andrew. Your earlier comments with the previous guest, are we back to the start? And it certainly feels like that, right? I mean, think about the shipping companies and everybody that has to transit through that. You cannot make decisions based on what we're seeing globally, but from both sides. And now, the US wants to put a toll on it. It's become a private equity kind of a hostile takeover situation, frankly. So look, it does not give you confidence. And to answer your question very directly, I think cash is offering enough, and you've got to be tactically smart with cash. And alongside that, I think you've got to go uncorrelated liquid alternatives, uncorrelated with both bonds and equities is where we're seeing the opportunity. So I think there is opportunities to make selective investments, but I think you've got to continue to be a little bit cautious. So we have reduced the severe underweight that we had leading into the MOU, but we are still slightly underweight risk assets in our asset allocation multi-asset strategies. Because of exactly this, MOU has pretty much turned into a MOM, Memorandum of Misunderstanding.
Misunderstanding. Yeah, good point. So, Zach, of course, we're just about to enter US earnings season, then, of course, followed by our own earnings season here. How do you think the market is set up, I guess, based on what you've seen, particularly over the past half?
Yeah, look, it's interesting. I think it's just interesting point to note that if you break down, decompose the returns for key developed markets like Australia, S&P 500, Europe, and Nasdaq, predominantly earnings have been the key drivers of returns. With Australia, dividends also help. But if you look at Australia and S&P 500, multiple expansion there's been absolutely no multiple expansion for S&P 500. It has still provided you in local currency terms about 9% return, and in Australian dollar terms it's been about 3%, it's about 6% or thereabouts. In Australia, you've actually seen a multiple compression, and so basically investors, and you think about CSL, look what CSL has done. Look at what some of the other key the players, the constituents of the Australian index have done. Basically, investors have said we will pay less for the earnings growth. But I think the dark blue line is showing you that earnings growth is still the large major driver of the returns in the first half. And look, if things come out pretty strong, and so if you look at the earnings setup for quarter two S&P 500, they're looking at 22%, I believe. Heading into quarter one, it was 12% estimates. They ended up delivering 26%. So our view is, and which is why I kind of agree with the previous presenter, that I do agree that over the next quarter, quarter three, and potentially quarter four as well, you're likely to see this resilience and this momentum in earnings carry sort of the markets through towards the end of which is certainly our expectation. But it'll be very interesting, obviously, what the quarterly results, which kick off today, I think, with the banks in the US. And then for Australia, I think given the lackluster return of the ASX 200, again, it's the earnings that we're focusing on. But because of that multiple compression that we've experienced in the first half, that could flip around for the Australian market, and you may see a nice decent 6 to 8% return, which will give you a nice decent return for the rest of the year or for the full year. So there's a lot to digest over the next month or two.
Zach, obviously a lot of focus on the Fed's next moves. We may get some hints, certainly getting some CPI data this week. But yeah. In fact, you've got a chart perhaps illustrating what we should be looking at right now.
Yeah, look, there's a plethora of data points out there, but if you are a market bull, if you are a bonds bull, this is the chart that obviously you are pointing to. Very simply, the light blue line is obviously the core CPI in the US. And remember, if the Fed starts cutting, and because CPI inflation is going down, that will give room for everybody else against, and including the Australian RBA, to start reducing their rates, because everyone wants to manage their rates differential because they want to manage their currencies, right? So directionally, the Fed can change a lot globally. But this is basically showing the light blue line is obviously the current CPI in the US core, and the dark blue line is trueflation. It's basically blockchain technology that takes in millions of dollars, millions of data points, to basically give you a current read on where inflation is going. So this is what the market bulls and bond bulls are saying, that the trueflation reading, which has been a pretty accurate reader, will call her of inflection points in CPI in the US. It leads by 40 to 75 days. Now, that is obviously trending lower. And so if that is trending lower, the current spike, the divergence that you're seeing could be short-lived. And if the core CPI starts to turn, then obviously Kevin, the new Fed chair, wants to cut rate. Then if the core CPI starts turning, as suggested by the trueflation, that will give more momentum to risk assets and obviously momentum to bond yields and bond prices. So I think keep watching those two. But the flip side is, if core and as it showed in early part of this year, trueflation could bounce back up as well. Then all bets are off, and you're looking at another market sell-off.
Now, Zach, of course, it's all been about the AI trade. Now, in Australia, the key way of playing that has been via data center. We've seen that growth, amazing capex that's still coming through in that regard. However, interesting to see how some of those data center players have actually performed.
Yeah, look, and I just want to raise it for the fact that I think this is one of the reasons the Australian market has also lagged the global peers, because our data center players, our AI players haven't really caught up. In fact, they've gone backwards. And if you look at Australia, if you look at the whole AI build out, I hear nothing but data centers. And then you look at NextDC, which is a high quality company, pure play. But if you look at its returns over the last 5 years, 3% per annum. And then if you look at some of the equivalent guys overseas, like Equinix, even Goodman Group, which is now pretty much become another proxy for data center growth, 7% per annum, nearly 8% per annum, and Equinix globally in AUD, 8.3% per annum, and NextDC, 3.3% per annum, basically, which is well below the ASX 200. So, I mean, if you were in this trade going, yep, I'm set, data centers, I mean, I'm pretty sure you can't do this without data centers, your returns have been dismal, and there's been plenty of spikes. But if you had a buy and hold strategy, and NextDC is trading on a 44 times EV EBITDA. And that's some of the multiples sell side guys are putting to justify $18, $20 price targets. But at the end of the day, show me where the money is, and NextDC just hasn't delivered for those that went down that route.